In this video, I just wanted to have a quick look at Meta Platforms, or Facebook, which it's more commonly known as. The other day, on Wednesday, the earnings came out, and they was actually quite alright in my opinion. Again, like Netflix, even though Netflix dropped 20%, there was good earnings, but the stock's fallen 26%, which is the biggest one-day decline that this stock has ever seen. You've got one here, 16% in 2018. We'll probably go back further and see more. But I think that personally this fall is slightly overdone, and I just wanted to have a look at what the technical picture sort of possibly looks like. And I also wanted to actually read over the actual report and just compare some numbers so that you can make that judgment if you feel like this fall was justified or not. In my opinion, I don't think it was. I don't think it's worth 238, and there's a reason for that, and I will go into that later. But overall, I think that this could provide a good buying opportunity, but there are going to be headwinds definitely for this company this year and next year as they change the way that they do things with the metaverse stuff. It's the 4th of February. My name's Tyrone, and you're watching Minipip. Jumping straight into the video, the first thing that I want to look at is the report that they published. And if we just look already at the revenue, costs and all the sort of income statement, we've got a record quarter of 33.6 billion. This time in 2020, or the equivalent time 2020, they did 28 billion. So that's a 20% increase, which is great. Your net income is down slightly by almost $1 billion. But there is one thing here which I don't think when you see on CNBC, what you're not seeing is the effective tax rate. They've paid an additional a higher tax rate of 19%. So actually, even though the revenue was smaller, you got a change year on year of 20% and a 32% increase on profit before tax, but the taxation this quarter was higher than it has been before, 19%, and higher than it has been ever before. So this is the highest tax rate that they've actually been charged, and as a result, on the face of it, it makes their earnings look a lot worse than the previous quarter by $1 billion. But that's not actually the case in my opinion. They've just been taxed higher. They've actually been as profitable, if not more profitable, than that previous quarter on the revenue. Looking at the actual numbers as well, we've seen a 37% increase in revenue from 20 to 2021, and again we've seen net income go from 29 to 39, and the tax rate has also gone up. So they've made an additional $10 billion on the turnover, which is in line with the turnover as well. But they've also had an additional 5% hike on their tax rate, which is morally right. I agree with that. But what if I don't really think that should be an issue, and I've seen reports on CNBC saying, oh, profit's down, it's the lowest, the turnover's gone up, the profit's down. So yeah, because they've been taxed more, and that is morally right, and that's what needs to be done to get us out of the pandemic, because obviously all the money that's been given to people and to companies over the last 12-24 months has to be repaid back some way or another. In the UK, it's coming in April in the form of national insurance and multiple other things as well. Looking at the breakdown of it as well, it's mostly from the advertising revenue, which is what I would have expected. So there's no issues there. In terms of investor security, that could be a slight issue. So they only have advertising really as their way of making money. There isn't really any other way for them to make money, and that's probably why they're jumping into the metaverse, because at some point social medias will probably go out of fashion, or that you'll have some other thing that'll be more entertaining, and they can lead that way because they also have all the money to do that. Just looking at the balance sheet as well, we've got a good balance sheet in my opinion. We've seen cash equivalents go down from 17.5 to 16.6, so that's a $900 odd million decrease. I'm not particularly concerned about that because total assets are still up $6 billion. The one thing that does maybe potentially look a slight bit concerning is you've seen a $10 billion increase in total liabilities, which is essentially the debt that they've got in the company. And if we just look into it a little bit more, 3 billion is in accounts payable. You've got around 2 billion in accrued expenses and liabilities, and then you've got the current liabilities coming in at 21 billion, and that's where you've seen that increase by quite a bit. Lease liabilities as well, they've gone up by about 3 billion, and other liabilities have gone up by a billion. So they're definitely increasing their costs more. But even though, if we see you've got 41 to 165, you're still left with 121 billion net, 124 billion net positive assets, which is only down 4 billion from the previous year. And given all the change that they're trying to do, and they're trying to lead the future in terms of innovation and virtual reality, I definitely think that this is definitely overdone, and especially the fall is overdone. And there was a bit of a report that I did see, I think it was just a bit further up, I'll see if I can find it, where it did, here it was. Yeah, so it was a commentary by the financial officer. First quarter revenue is expected to be 27 to 29, and given that we've got 33 billion previous quarter, which is what we've just done, that would suggest that while we will have an increase year over year, we will have a decrease from quarter 4 of last year to quarter 1 of this year by maybe 10%. And that's probably one of the main reasons why we've seen this stock fall 25%. But a fall of 10% in revenue, in my opinion, should not see a stock fall 25%. Coming on almost 40% since its highs. It's still a mega profitable business running on some really great margins. It's around a 30% profit margin, and on these types of numbers I just don't believe that that's justified. Some headwinds, which again most companies, should I say not every company, but most companies are going to go through. Apple iOS is one of the issues that they're going to face. I believe I saw a report saying that that's going to cost them about 10 billion over the space of the year, because of the new changes with security that Apple are doing. That would probably be, in my opinion, one of the biggest concerns, because Facebook and Apple, they're big competitors in some way for, well, they're not competitors, but they need to work together to be successful, because they work together, basically. If you get an iPhone, you use Facebook, Instagram on your iPhone, so they need to have a good relationship. The second one is macroeconomic challenges, which I would have expected anyways, like any company. And the second one is exchange rates. Interest rates are going to go up, which is going to probably cause the value of the dollar to go up in value, which is going to make the dollar more expensive against other countries, which means that the yield return in, say, countries like the UK, countries like Europe or China or Australia, wherever they're operating, it's going to have a bit more of a squeeze on the amount of money that they can make. And that, this is another one to watch, because all central banks this year are going to increase interest rates because they can't deal with the inflationary rates. So these two are sort of swings and roundabouts. So it's very difficult to say, but I can agree with this one quite a lot, that the exchange rates are going to do some damage, because it's going to make a difference to the current accounts and what they've got in each of those accounts. So overall, from the financial point of view, I'm happy with the business. It's not like this is a loss, and while people do see that this is an 8% decrease, what people don't see is the increase in taxes from 14 to 19%, which is a 5% increase. And that is probably one of the reasons why, or there or thereabouts, we've seen that decline in net income. Now, looking at the chart, it's pretty damn ugly. But one of the things that I first wanted to point out with, for some reason, IG's chart just lets me go back to 2012, and I should go back further. But anyways, looking at this decline in 2018, this is the one that I wanted to look at. We had a 42% decline in 2018. If we duplicate that and we look at 2020, we had at the same time, we had a 38% decline in 2020. In 2018, we had a 42% decline. And again, we had a relatively long sustained 2016, 17% decline here. And again, we have another decline here, which we're going through at this moment in time, which is not over yet, which is 37%. We had a bigger decline in 2018, yet if you was holding this stock at $210, you would still be up 5-10% over the last few years. While that isn't great, it's still a return, but what people aren't looking at is a longer term picture. You've had 3 drops in this stock where the stock has fallen over 35%, and we've still continued higher. We had a period of consolidation for almost 2 years here where we didn't do anything, and this is why I think that Facebook is undervalued at its basis of the revenue. If we look at that revenue and we look at the year on year, we've seen 37% increase in profitability. And if we just quickly pop on to macro trends and we look at Facebook as well, we'll see that if we compare 2018 numbers to 2021 numbers, I personally don't think that it's justified. So 2018 we was doing 55 billion, and now we're doing 117 billion. So we're doing over double what we was in 2018. Profits was coming in at 22 billion after tax. Profits are now coming in at 39 billion after tax. So they're nearly double what there was. And I just don't see why, if you're seeing revenue double and you're seeing profits double over the space of the next 3 years, from this point here, I would have thought that the stock would be somewhere in the region of around 400, and we did get there at one point, and that is my sort of point, that the stock has followed that rule of we've doubled turnover, we've doubled profitability, so therefore the stock should double, and yet the stock is now down 40% and is up almost just 10% from that low there, which tells me that it is undervalued on the basis of viewers comparing how this has performed since 2012 here from that revenue point of view. So I definitely think that it's undervalued. In terms of the actual chart then, you've got the RSI, which is reading 24. It's never read this before. Read it here in 2012. We read that, and we did have this period of consolidation for a year, and we then got this massive great increase here, which was almost 200%, and that is potentially what could happen here. We could just see consolidation here for the next year while investors gain their confidence in Facebook and figure out if this metaverse thing is actually going to be successful, and then the stock could easily plummet up to $500 or $600, and people could sit there and say, oh, that's not justifiable. I think it is. They're leading the way. They're one of the biggest companies in the world. They're one of the most profitable companies in the world. Why can't they do it? And so as a result, I think that this RSI is telling us that right now we're the most oversold that we have been in almost 10 years. It is 10 years. It's the most oversold we've been in 10 years. Even the pandemic wasn't that bad in 2018. It wasn't even that intense in 2018. It was a gradual decline. This was just a fall off a cliff. From another technical standpoint, MACD is trending heavily low, and I would suggest that at some point when we see this sort of level out back to these levels, minus 1,100, if these start to level back up again, that could be your opportunity to then go long. But generally, I think that this looks pretty good. Levels to watch for the stock. We've got it's a bit difficult really. You've probably got support here. I'm just going to drawing random lines on as such, but this is what you do. It's what everybody does. You're looking at around $210 here. If you do break that, then your 150s on your card. But honestly, if 150 is hit, I'd be absolutely gobsmacked. I really would be. But to the upside, you're going to have some issues at the 100 period moving average here, which is at about 300. That's definitely going to be an issue. A break above 300 is going to see 340 become a bit of an issue, and then you've got this major resistance here at about 350. Break above 350, we go towards 400. This isn't going to happen anytime soon. It's not going to happen next week. It's probably not going to happen in the next couple of months. However, by the end of the year, or maybe by the end of 2023, in the next 18 to 24 months, we could definitely see this stock recover and come back up. It's not advice. I'm not telling you to buy or sell it, but I think that this is personally cheap. I'm up here holding at like 330, so I would want it to come up. and you could say I'm biased, but even now I would be adding, or I will be adding more at these levels to average my position down, because I think it's a great stock. I will be doing a post as well on Mini Pip, and just while we're on this, I have got a new website which has launched with a full category all about investing, ISAs, any types of technicals, and I'm working on that over the next couple of weeks to upload more. YouTube videos are all on there, and the analysis which I post anyways is also on there. There's free WhatsApp groups as well that you can join, where I post stuff as well. And I will be doing keeping a close eye definitely on Facebook, as it's one of my favourite stocks. Thanks for watching.